come to order. Senator Brown has been delayed a little bit, but I'm going to go ahead because, as I think most people realize, we had to readjust the time of this hearing so that we could accommodate the fact that votes have been called on the floor at 10:30. That means that senators are going to need to really stick to their 5 minutes, and even then we may not get through for everybody, and I apologize for that. I'm sure Senator Brown and I will stick around for 15 or 20 minutes into the first vote so we can go as long as we possibly can. I will waive my questions. I won't waive my introductory statement, though, and I will start with that right now. Welcome, Chairman Powell. Today, the Federal Reserve Chairman Jerome Powell will update the committee on monetary policy developments and the state of the U.S. economy. The U.S. economy continued to expand in 2019, exceeding 2% growth for the third straight year, as the American people enjoy the longest continued economic expansion in American history. The labor market is strong, with the labor force at an all-time high of 164 million people. And the most recent jobs report shows that employers added 225,000 jobs in January alone, with the unemployment rate at 3.6%, remaining near a half-century low. Wages also grew in January by 3.1% from a year earlier, and this is important, making it 18 consecutive months that pay has grown at an annualized pace of 3% or more. Americans' view on their personal financial situations are increasingly optimistic, according to Gallup trends. Nearly 6 in 10 Americans, or 59%, now say they are better off financially than they were a year ago, up from 50% last year. Tax reform in 2017 and right-sizing regulations, including under the Economic Growth, Regulatory Relief, and Consumer Protection Act in 2018, have undoubtedly helped fuel this strong economy and labor market. Americans are set to benefit even more when considering the effects of the USMCA and the Phase 1 trade deal with China. Despite this substantial progress, there are several external factors that could have a meaningful impact on the economic activity and our financial markets that need to be better understood, including the Fed's decision to maintain a significantly larger balance sheet in the future, including its recent decision to purchase Treasury bills in response to volatility in short-term borrowing rates. The Fed's future plans to maintain stability in short-term borrowing rates, including potential structural market-based fixes, and risks of transition away from LIBOR to an alternative reference rate, and steps that should be taken to ensure a smooth transition and curb risks to businesses and financial markets. And finally, the potential impact of the coronavirus on global commerce and growth. The Fed has also taken a number of important supervisory and regulatory actions that merit attention. The Fed and other federal financial agencies recently proposed amendments to the Volcker Rule that would improve, streamline, and clarify the covered funds portion of the rule. That proposal builds on the agency's simplification of the Volcker Rule in 2019, standing to improve market liquidity and preserve diverse sources of capital for businesses while striking the appropriate balance with safety and soundness. Additionally, many Banking Committee Republicans and I have raised serious concerns in the past with the agency's supervisory and examination processes, including the use of guidance as rules. In January, Fed Vice Chairman Quarles offered a roadmap to foster transparency, accountability, and fairness in bank supervision, including tailoring the supervisory framework to better align with the categories developed under the Fed's domestic and foreign bank tailoring rules, putting significant supervisory guidance out for public comment and submitting it to Congress under the Congressional Review Act. Other common-sense improvements to the supervisory process, such as a rulemaking that would cover the agency's use of guidance in the supervisory process. This roadmap is greatly encouraging, and I urge the Fed to take steps to put it into motion. Finally, there is a constant innovation, including in the financial services industry, to increase resources to unbanked and underbanked populations, reduce friction in payments, and increase efficiency in the delivery of financial products and services. Some recent examples are Facebook's announcement of Libra, a new stable digital cryptocurrency backed by a reserve of real assets and leveraging blockchain technology. Work by global governments and central banks to explore the development of central bank digital currencies, especially amid rumors that China's launch of a digital yuan is imminent. the numerous applications of distributed ledger technologies, including in clearing and settlement, identity verification, and cross-border transactions, and some financial institutions' adoptions of public cloud technologies. As I've stated in past hearings, it seems to me that technological innovations in this space are inevitable and that the U.S. should be leading in developing what the rules of the road should be. During this hearing, I look forward to hearing your thoughts, Mr. Chairman, on these important issues and about the work that the Fed is engaged in to appropriately address them. And again, thank you for joining us today. Senator Brown.
Thank you, Mr. Chairman. And Chairman Powell, nice to have you back, and thank you for your accessibility and the conversations you have with all of us in both parties on this committee. Before we start, I want to say a few words about what happened last night when we got word that Jessie Liu's nomination had been withdrawn. She was to appear in front of this committee, or she was going to appear in front of the Senate. When President Trump withdrew her nomination, she was going to appear in front of this committee tomorrow. I heard some of you, my colleagues and my friends, say that the president would be chastened by impeachment. Some of you told me you knew what the president did was wrong. Some of you privately to me told me how much you think he lies. But that, you also said publicly, that wasn't enough to rise to the level of removal from office. And many of you asserted that he had learned his lesson. He would not do these things again. He wouldn't try to, through illegal means, try to change the 2020 election. It's pretty clear the President of the United States did learn a lesson. The lesson: he can do whatever he wants. He can abuse his office. He'll never, ever be held accountable by this Senate. That was the lesson. He's now, since acquittal, gone on a retribution tour, starting at the prayer breakfast. A prayer breakfast, mind you, continuing through the East Room, where many of you were in the audience and applauded him as he personally attacked people who have served this country. He removed Colonel Vindman, a patriot and Purple Heart recipient who spent his life serving our country. He mocked his accent, his accent from his Ukrainian accent. He removed Ambassador Sondland, a Trump appointee, after he testified to the quid pro quo. And yesterday, and the reason I'm bringing this up today, is he continued the tour, interfering at the Department of Justice, strong-arming political appointees to overrule career prosecutors. Those attorneys withdrew in protest. Those professionals, I have no idea their political party, they're professionals, withdrew in protest from the case, and at least in one case resigned entirely from the department. We cannot give him a permanent license to turn the presidency and the executive branch into his own personal vengeance operation. You all know it's happening. Even the senator that just walked out knows that it's happening. I'm afraid that's what we're seeing, a personal vengeance operation. No one should be above the law. If we say nothing, and I include everybody in this committee, I include myself, if we say nothing, it will get worse. His behavior will get worse. The retribution tour will continue. We all know that. Mr. Chairman, now on to the issue at hand. I welcome Chairman Powell back. Earlier this week, Bloomberg reported on a profitable and fast-growing Spanish company. Grifols has opened up branches in 36 states. They buy and sell plasma, nice clinical-sounding word that means blood, as we know. Americans who are struggling to make ends meet are lining up to sell their blood to put food on the table. The blood harvesting business is booming. Grifols stock is doing great. It's hard to think of a better metaphor for the Trump economy. On Monday, the S&P 500 and NASDAQ both reached record highs. 2019, J.P. Morgan Chase had the best year for any U.S. bank in history, $36,000 million in profits. Big corporations are spending hundreds of billions of dollars on stock buybacks and dividends. On paper, the economy's been expanding uninterrupted for over 10 years, although the growth the last 3 years of the Obama administration has been greater than the growth of the first 3 years of the Trump administration. We know that too. But if you talk to the vast majority of people who rely on paychecks, not investment portfolios to earn a living, you get a very different story. They've been bleeding for years. Most families don't understand why the harder they work, sometimes at more than one job, the harder it gets to afford pretty much everything: childcare, health care, rent, college tuition. The people in this room may remember last September when the financial industry went into a panic over a benchmark interest rate passing 10%. Wall Street faced uncertainty, so we respond. Fed leapt into action. Smart government employees came up with a plan that led Federal Reserve lending about $200 billion every day into financial markets through a mechanism that hasn't been used since the financial crisis. $200 billion every day. Let me be clear, I don't think it's wrong for the Fed to be creative and make sure the economy keeps working. It's in everybody's interest, Mr. Chairman, for banks to keep lending money and credit to keep flowing so businesses can invest and manufacture, consumers can buy houses and cars. My problem is this: when Main Street faces uncertainty, no one at the Fed jumps to action or gets creative. The president doesn't criticize by tweet in person, by name, the chairman of the Federal Reserve when he says he never demands corporations raise wages for their workers. That's not ever his criticism of Chairman Powell. It's hard for families to understand why Wall Street gets worked up about a 10% interest rate when so many families are lucky if the payday lender down the street charges them less than 400%. Small businesses having trouble making payroll don't have access to so-called repo funding at their local Fed branch. The Fed doesn't take action when its own research has found that 40% of Americans don't have the cash. I mean, think about that. Probably not many people in this hearing room, but 40% of Americans don't have $400 in cash when their car breaks down to get to work to be able to fix it. So they go to the payday lender, and then things spiral downward. Nobody raises alarm bells when 40 million Americans predict they'll miss at least one credit card payment, which means $1.2 billion in late fees will flow from the pockets of struggling families to help J.P. Morgan and Chase earn $36 billion last year. Serious people haven't dropped everything to bring down the cost of housing or raise wages once they found out that 1 in 4 renters are paying more than half their income toward housing. One thing goes wrong in their life, their lives turn upside down. People look at that, they see 2 different economies and 2 different responses. We hear a lot about the divides in this country between red and blue, between rural and urban, the coast and the heartland. People watch MSNBC and people that watch Fox. But people in all these places feel no matter how hard they work, they can't maintain any real economic security. The real divide I see is between those whose problems are considered an emergency and those whose struggles Wall Street and large parts of Washington decided they can ignore. The Fed needs to get creative for the people who make this country work. Particularly, it's become pretty clear that the president and the majority leader are simply not about to. President Trump brags about a soaring stock market that he's pumped up with his deficit-busting million-dollar tax breaks for billionaires. Deficits exceeding $1 trillion. Don't hear much about that anymore. And now he wants to pay for those tax cuts. Sorry, we got a big deficit. We got to pay for those tax cuts, as he said in Davos and he's saying in his budget, by cutting Medicare and Medicaid and Social Security. He lies about a blue-collar boom. I heard it at the State of the Union that night. I was fairly incredulous. When my own state of Ohio, job growth has been anemic or non-existent. Manufacturing jobs are stalling compared to when he took office. And now, in his budget, after promising workers in Lordstown, Ohio, don't sell your homes, we'll bring those jobs back, to kill the loan program that was giving the community of Lordstown a little bit of hope that some manufacturing jobs actually would come back. Chairman Powell, you and your highly capable staff at the Fed have been proactive and creative in protecting Wall Street and the money markets from the president's erratic behavior, and I'm glad you have. We're all appreciative of that. But what I hope to hear from you today is how you're going to be proactive and use that same level of creativity to make this economy work for everyone else. Thank you.
Chairman Powell, I, for one, commend you for the work that you're doing. I think that there are tremendous results that I expect you will discuss with us today from the efforts that you've undertaken. You may now make your statement, and then we will proceed.
Thank you very much. Chairman Repo, Ranking Member Brown, members of the committee, I'm pleased to present the Federal Reserve's Semiannual Monetary Policy Report. My colleagues and I strongly support the goals of maximum employment and price stability that Congress has set for monetary policy. Congress has given us an important degree of independence to pursue these goals based solely on data and objective analysis. This independence brings with it an obligation to explain clearly how we pursue our goals. Today, I will review the current economic situation before turning to monetary policy. The economic expansion is well into its 11th year and is the longest on record. Over the second half of last year, economic activity increased at a moderate pace, and the labor market strengthened further as the economy appeared resilient to the global headwinds that it had intensified last summer. Inflation has been low and stable, but has continued to run below the FOMC's symmetric 2% objective. Job gains averaged 200,000 per month in the second half of last year, and an additional 225,000 jobs were added in January. The pace of job gains has remained above what is needed to provide jobs for new workers entering the labor force, allowing the unemployment rate to move down further over the course of last year. The unemployment rate was 3.6% last month and has been near half-century lows for more than a year. Job openings remain plentiful. Employers are increasingly willing to hire workers with fewer skills and to train them. As a result, the benefits of a strong labor market have become more widely shared. People who live and work in low and middle income communities are finding new opportunities. Employment gains have been broad-based across all racial and ethnic groups and levels of education. Wages have been rising, particularly for lower-paying jobs. GDP rose at a moderate rate over the second half of last year. Growth in consumer spending moderated toward the end of the year following earlier strong increases, but the fundamentals supporting household spending remain solid. Residential investment turned up in the second half, but business investment and exports were weak, largely reflecting sluggish growth abroad and trade developments. Those same factors weighed on activity at the nation's factories, whose output declined over the first half of 2019 and has been little changed on net since then. The February Monetary Policy Report discusses the recent weakness in manufacturing. Some of the uncertainties around trade have diminished recently, but risks to the outlook remain. In particular, we're closely monitoring the emergence of the coronavirus, which could lead to disruptions in China that spill over to the rest of the global economy. Inflation ran below the FOMC's symmetric 2% objective throughout 2019. Over the 12 months through December, overall inflation based on the price index for personal consumption expenditures was 1.6%. Core inflation, which excludes the volatile food and energy prices, was also 1.6%. Over the next few months, we expect inflation to move closer to 2% as unusually low readings from early 2019 drop out of the 12-month calculation. The nation faces important longer-run challenges. Labor force participation by individuals in their prime working years is at its highest rate in more than a decade. However, it remains lower than in most other advanced economies, and there are troubling labor market disparities across racial and ethnic groups and across regions of the country. In addition, although it is encouraging that productivity growth, the main engine for raising wages and living standards over the longer term, has moved up recently, productivity gains have been subpar throughout this long economic expansion. Finding ways to boost labor force participation and productivity growth would benefit Americans and should remain a national priority. I will now turn to monetary policy. Over the second half of 2019, the FOMC shifted to a more accommodative stance of monetary policy to cushion the economy from weaker global growth and trade developments and to promote a faster return of inflation to our symmetric 2% objective. We lowered the federal funds rate target range at our July, September, and October meetings, bringing the current target range to 1.5% to 1.75%. At our subsequent meetings, with some uncertainties surrounding trade having diminished and amid some signs that global growth may be stabilizing, the committee left the policy rate unchanged. The FOMC believes that the current stance of monetary policy will support continued economic growth, a strong labor market, and inflation returning to the committee's symmetric 2% objective. As long as incoming information about the economy remains broadly consistent with this outlook, the current stance of monetary policy will likely remain appropriate. Of course, policy is not on a preset course. If developments emerge that cause a material reassessment of our outlook, we would respond accordingly. Taking a longer view, there's been a decline over the past quarter century in the level of interest rates consistent with stable prices and an economy operating at its full potential. This low interest rate environment may limit the ability of central banks to reduce policy interest rates enough to support the economy during a downturn. With this concern in mind, we've been conducting a review of our monetary policy strategy, tools, and communications practices. Public engagement is at the heart of this effort. Through our Fed Listens events, we've been hearing from representatives of consumer, labor, business, community, and other groups. The February Monetary Policy Report shares some of what we've learned. The insights we've gained from these events have informed our framework discussions as reported in the minutes of our meetings. We will share our conclusions when we finish the review, likely around the middle of this year. The current low interest rate environment also means that it would be important for fiscal policy to help support the economy if it weakens. Putting the federal budget on a sustainable path when the economy is strong would help ensure that policymakers have the space to use fiscal policy to assist in stabilizing the economy during a downturn. A more sustainable federal budget could also support the economy's growth over the long term. Finally, I'll just briefly review our planned technical operations to implement monetary policy. And the February Monetary Policy Report provides details of our operations to date. Last October, the FOMC announced a plan to purchase Treasury bills and to conduct repo operations. And these actions have been successful in providing an ample supply of reserves to the banking system and effective control of the federal funds rate. As our bill purchases continue to build reserves toward levels that maintain ample conditions, we intend to gradually transition away from the active use of repo operations. Also, as reserves reach durably ample levels, we intend to slow our purchases to a pace that will allow our balance sheet to grow in line with trend demand for our liabilities. All of these technical measures support the efficient and effective implementation of monetary policy. They are not intended to represent a change in the stance of monetary policy. As always, we stand ready to adjust the details of our technical operations as conditions warrant. Thank you. I'm happy to take your questions.
Thank you, Chairman Powell. And as I said before, I won't use my 5 minutes for questions. And in fact, I will not use much of my 5 minutes at all, trying to set a standard for the rest of the members of the committee. Before I turn the time to Senator Brown, however, and yield my time, I wanted to indicate that it's been brought to my attention that Senator Shelby, who unfortunately isn't able to be here right now, recently became the longest-serving member of the Senate Banking Committee in history. He began his service on the committee on January 6, 1987, and has now served approximately 33 years, 1 month, and 6 days. That surpasses Senator Sparkman, interestingly also of Alabama, who previously served on the Banking Committee between January 6, 1947 and January 3, 1979, almost 32 years. Senator Shelby has clearly seen dramatic changes in the financial services industry over those years, and himself has had a meaningful impact on financial institutions, markets, and consumers during his tenure on the committee, including as chairman. I take this opportunity to thank him for his service on this committee and congratulate him on this significant milestone. Senator Brown. Yeah.
Is he here?
He's not here. I yield my time to you.
We'll clap again when he comes. Thank you, Mr. Chairman. Thanks. When the Fed says it's nearing maximum employment and the labor market is strong, it could mean workers have one good paying job, or it could mean that a worker is working under 40 hours at 3 part-time jobs at minimum wage. I think this highlights how the economic recovery hasn't benefited nearly everyone. You hear these statistics, 25% of people may pay half their rent and half their income in rent. 40% of Americans can't come up with $400. So clearly that's not reaching everyone. If you have to work 3 jobs, or if you're working in a job in one of the 10 fastest growing professions, 7 out of 10 of those jobs are this, you still can't afford rent. Something is wrong. I appreciate you've been on a listening tour and looking forward to a report, but I want to know who do you have at the Fed working on bold and creative ways to use the Fed's authority, some tools we probably don't know about, using your authorities to help working families that aren't benefiting from economic growth? What can you do to make sure that most of our economic growth, not a sliver of it, but most of our economic growth ends up in workers' pockets?
Well, our tools are not focused on distributional effects, really. They're focused on aggregate effects. We do not have those tools. Other agencies do, and of course, elected officials hold the power to address those issues. But I will say that the thrust of our review of monetary policy, the first we've done of this nature, is to assure that we have the tools to carry out the mandate you've given us of maximum employment and stable prices in a world where inflation is trending lower, where the Phillips curve is very flat, so that the connection between inflation and tightness in the economy is very, very low now, and also where interest rates are quite low, which creates a very challenging environment for us to carry out the job you've given us, and that's why we're doing a deep dive on issues around our strategy, tools, and communications.
Okay, I ask you to, and these conversations can take place individually too, but ask you to be as creative as the Fed was. I mean, I just have a list here of extraordinary federal actions that didn't require Congress. I'm not arguing Congress has done its job. Senator McConnell and the president have refused to raise the minimum wage. It's been stuck for 11 years at under $8. They took away overtime for about 2 or 3 million Americans because of truncating the overtime rule, tax cuts for the rich, and now cuts for Medicare. I mean, we know Congress isn't doing its job to redistribute income in any way that's fair to hundreds of millions of Americans. We know that, but just this list quickly: the maiden lane direct purchase of assets, the primary dealer credit facility, converting investment banks to bank holding companies so they could borrow from the discount window. The Fed has been very creative to the country's benefit when Wall Street has reached difficult times, has run into difficult times, sometimes of their own making, but the Fed I'm a supporter of the Fed. Some people with my political philosophy aren't. And I think that you have stepped up in many ways. I ask you to be as creative in thinking of ways that this wealth is shared beyond the 1 or 2 or 5 or 10% who are doing very well, who are thrilled with the economy the way it is, and it just doesn't reach so many. One other question, Mr. Chairman. I'm worried about other risks in our economy. I'm glad the Fed's taking leverage lending seriously, incorporating it into stress tests. Same time, we're seeing the financial system get more and more exotic. J.P. Morgan Chase, through a supposedly unaffiliated fund, wants to buy an electric plant in El Paso, also owns a stake in a nuclear power plant. That means that J.P. Morgan Chase could likely own a nuclear power plant. The Japanese equivalent of Amazon wants to form an industrial loan company in Utah so it can get the benefits of being a bank without the regulation, and recently voted with other bank regulators to weaken the Volcker rule by reversing protections in the 2013 rule, allowing for more risky and leverage investments. Are we going in the right direction? It seems the financial system, again, is getting more complex, more exotic, things people don't understand. Shouldn't we be focused on simplifying it?
Well, what we are focused on is maintaining much higher capital, much higher liquidity requirements, stress tests, as you pointed out, that keep the banks on their toes and do address in a timely way the issues of the day, and also resolution planning. So those are the big 4 important measures broadly that we put into place after the financial crisis, and we're focusing on sustaining those, making them more effective, and keeping them strong.
Senator Toomey.
Thanks very much, Mr. Chairman. Welcome back, Mr. Chairman. Good to see you again. I have several somewhat technical questions I'd like to go over with you, and some of them we've discussed to varying degrees in the past. But one is the Fed's real-time payment system. As you may recall, I was never convinced that this was a great idea for the Fed to pursue this, since we have a private sector system in place, up and running, and really encouraged by the Fed back in the day. But I get the Board of Governors has made its decision. Here's my question for you. A number of constituents have expressed the concern that we're going to end up with 2 systems that are not fully interoperable. And to the extent that employers and financial institutions and other participants would be plugged into different systems, if they are not fully interoperable, there's a real concern that that is going to, at a minimum, diminish the ability to innovate in these systems going forward. So I guess I'm wondering if you could just briefly, because I do have several other topics, just address the question of whether it is a priority of the Fed to ensure that the FedNow system will be fully interoperable with the clearinghouse system.
I think full interoperability is the goal. It will be challenging to reach it, but it's high on our priorities to assure interoperability. It's something we're very focused on in the design stage.
Okay, and as I'm sure you're aware, the clearinghouse system is committed to having flat fees and not providing discounts for volume and the size of transactions, provided that the FedNow system does not provide those kinds of discounts. Can the Fed commit that it will have uniform pricing on this platform?
We haven't made that commitment, and it's not clear that that's what that the banks who really wanted us to do this are looking for.
Well, I would just, this is often cited as a reason why the Fed needed to do this is because the private system might discriminate on the basis of price. So I think it is important that the clearinghouse system has volunteered. Clearly, they are happy to be regulated if need be to ensure that this would occur. It would be really ironic and a shame if it turns out that it's in fact the Fed that makes it more expensive for small banks to participate. So let me move on to SOFR. So as we've discussed, one of the challenges of replacing LIBOR is that LIBOR has an embedded credit risk element. It's an interbank rate, whereas SOFR is a risk-free rate because it's essentially a repo rate. And that mismatch could conceivably create some problems especially to the extent that banks are funding themselves in an interbank market that's subject to credit spreads that SOFR may not reflect. And so a mismatch in assets and liabilities could become problematic. So my question is, I think yesterday you may have, and I didn't see the transcript, so correct me if I'm wrong, but you may have suggested that there's a thought of trying to introduce a credit component, some kind of credit spread or credit risk component as either a complement or an alternative, or somehow integrate that with SOFR. And I'm just wondering, did I get that right? Is that something you guys are thinking about? Are you concerned about it at all?
I'll just quickly say that LIBOR itself we can't assume that it will be published past the end of 21. So that hasn't changed, and everyone needs to take that on board. SOFR is going to be the rate that a lot of the derivatives go to, and many across the broad financial system will go to. But a number of banks have come forward and said that they want to work on a separate rate, which would not replace SOFR, but would be credit sensitive, and so they're doing that now, and we're working with them to support that process. So we're open to that, but it doesn't mean that the transition away from LIBOR to SOFR will stop. It has to go forward.
Yeah, okay. Last thing on my list here, the glitch in the repo market. As you and I discussed briefly, my concern is when banks choose to earn less than 2% on excess reserves when they could be earning up to 10%, at least briefly, in the repo market. It suggests that there's something going on here, right? They could have put their money into the repo market. They chose not to. I'm not aware of an explicit rule that required that during the episodes when these rates spiked, but nevertheless it happened. And so I wonder, and I'm a little concerned, that there might be some kind of unspoken pressure on the part of regulators to favor cash on deposit with the Fed over the liquidity in the form of repo transactions that goes beyond what is actually in the rules. And I'm wondering if you share that concern, what you think about it. I know the Fed's response has been to provide liquidity, and that works in a given moment. But if there's an underlying problem that hasn't been fixed, then isn't there the risk that the spike in repo rates could reoccur, and then you have to provide liquidity again? Could you address that?
Sure. So there isn't a preference for reserves over treasuries in the LCR, but there is in the internal liquidity stress tests, in the sense that it takes one day to turn a treasury into liquidity. Just inherently there is. And I think the idea of putting treasuries and reserves on an equal footing in terms of their treatment so that they can achieve liquidity is a good goal, because we don't want to tilt banks in the direction of having to have more reserves than they really need. As long as the overall level of liquidity is at the appropriate level, we don't want to tilt them in that direction. It may well be that we're doing that. You may have seen Vice Chair Quarles gave a speech on this and talked about this issue at some length. So we're looking at ways to address that, and one of which is just to assume that the discount window is available in that stress test, which is a reasonable assumption to make. But I do think there are things to do there. And the reason is, as you mentioned, there was liquidity, but it didn't flow, so it wasn't liquid. And so the question is, why not? And we're looking at ways to address that will not undermine safety and soundness, but that will make the markets operate better.
Thank you.
Senator Reed.
Well, thank you very much, Mr. Chairman. Let me thank you, Chairman Powell, for your leadership. Thank you for joining us in Providence. It was a wonderful evening. And I think it's important, too, that your efforts to ensure the independence of the Federal Reserve. Without an independent Federal Reserve, our national policy making is, in my view, severely flawed. So keep up your efforts, please. You mentioned that we've had an expanding economy for 11 years. By my count, that would be 8 years under President Obama and 3 years under President Trump, but the expansion is good. But there's still some issues I think we should address. The Pew Center put out a report in January, and they indicated that the share of wealth held by middle-income families has been falling for roughly 20 years. And I presume, I'd like you to comment whether it continues to fall despite this expanding economy. And in addition to that, they point out that income inequality in the U.S. has increased since 1980. If it's still increasing, please comment on that. And it's greater than in peer countries, other countries that are similar to us in many other aspects. So despite this expanding economy, if we're seeing a shrinkage of wealth in the middle class and income inequality, those are social and political and economic trends that I don't think are sustainable over time. They go to the fabric of the country. So are those trends continuing, and what policy can we adopt, both fiscal and monetary policy, to change them?
Those are longer-term trends that I think are driven by important underlying factors, many of them global. And so I think that I would assume that the data will continue to move in that direction. I think what they show is that incomes have been moving up across the income spectrum, particularly if you look at benefits and if you look at after-tax effect, it gets more even that way. But it's been a particularly good time to be at the top end of the income spectrum. And I would point to two key problems I think we ought to address. One is low mobility. We actually have lower mobility from, say, the bottom quintile to the middle quintile or the top quintile than many other advanced economies. This is not our self-image as a country, and it's something we need to address. The other is just that the relative stagnation of those incomes in the middle and the low end. We want, of course, prosperity to be broadly shared, and it comes down to really education and training and things like that that enable people to do well in the modern economy, which is a globalized economy that is less about manufacturing, and the manufacturing jobs are more technical than they were. So we need a workforce that can benefit from technology and globalization, and those are policies that the Fed doesn't have our hands on.
No, you don't have those policies, but if we just sit back, those trends will continue, and they'll cause even further divergence between the vast majority of Americans and a very small group of Americans. So it's incumbent upon Congress, the executive, to start taking steps. Is that fair?
I think so, and I also think U.S. businesses get this very much now. If you talk to business leaders, they see the workforce and the need for widely shared. We want prosperity to be as widely shared as possible. You hear that all the time from business leaders and certainly government leaders as well. I do think it's an important national priority.
Thank you. Just switching gears here, the Community Reinvestment Act is being massaged by both the Office of the Comptroller of the Currency and the FDIC, and there's been some comments critical of their efforts, both not just by affordable housing advocates, but by some banking institutions, that they are not doing a proper cost-benefit analysis, that their proposal unintentionally could discourage revitalization of neighborhoods that really do need it most. And can you let us know what role you might play and how you can help get it right?
Sure. So first of all, we're not going to comment on their proposal, and it's out for proposal. I think all of us, including the FDIC and the OCC, are looking forward to seeing those comments and learning more. I think we do share the goal of modernizing CRA. Technology and demographics have really changed the delivery of banking services, particularly in rural areas, for example, but everywhere. So it's time to do that. It hasn't been done in 25 years. I think we agree on the goal, which is we want it to be more effective, and it would help that if it were more transparent, more objective. So I think we share objectives with those agencies, and we work closely with them for a long time to try to get completely on the same page. We developed our own approach, which was slightly different, a bit different, and we weren't able to get together in the end. But I think we should look at it as an ongoing process where we'll continue to learn. That's going to be our approach.
Again, thank you, Mr. Chairman, and I'll stress independence one last time.
Senator Sass.
Thank you, Chairman. Chairman Powell, thanks for being here. We're grateful for your work. You have been consistently raising warning bells about what you call the greatest threat to the financial system. You talk to many of us in private about cyber issues, and you said it yesterday over on the House side. I don't think it's breaking through. Can you summarize for us why you're awake at night, worried about cyber attacks on our financial system?
Sure. So they kind of pay us to be awake at night worrying about things. And I would say that if you look at what happened in the financial crisis, we had a game plan there. We implemented it over the course of 10 years. I won't say that it's perfect or anything like that, but we have a plan that is meant to address those kinds of things. What's new in the threat environment is the ongoing level of cyber threat and the increasing sophistication of it. And so that's what we spend a ton of time worrying about that. And the Treasury Department has really been taking the lead on that. And I think so we're very focused on it. We're focused on making sure that the financial institutions that we supervise are doing the best that they can to stay at the state of the art. Good cyber hygiene. It turns out that a lot of these things are just people failing to implement, updating their software and things like that. That's where a lot of breaches happen. So, I mean, it's an intense focus by supervisors and by financial institutions, also by non-regulated, non-financial institutions, companies that are in, all kinds of businesses are having this now. It's an enormous focus. We'll never say that it never feels like we've done enough, but it's just something we keep trying to get better and better at. Lots of resources on it in all the agencies and in all the companies.
And if you'd concretize for us, give us maybe 2 examples of a way that you think this attack could have, spillover effects. How do the dominoes work without giving somebody a template or a roadmap? You've talked in private a few times about ways that this could cause bigger consequences than 2008-9. How would that happen?
Yeah, without wanting to get too much into it, I would just say that confidence in the financial system is really important. The public has to have confidence in the financial system, and so a successful cyber attack on a payments utility, for example, would be challenging. We could address that, we could isolate it, we could fix it, but you would want to avoid somehow broader blows to confidence, because when confidence weakens, people will take their money out, they will stop acting and things like that. Uncertainty and lack of confidence are the enemy of economic activity and growth.
I think we need to also recognize that many different conversations we have with the Chinese government tend to have a benign diplomatic flavor. I think we should underscore what has happened this week with the Equifax hack having new headlines. So the 2017 hack of Equifax, which compromised the personal financial records of more than 30%, 35% of all Americans. The Justice Department earlier this week indicted 4 Chinese Communist Party officials affiliated with military intelligence in China. This isn't an accident. This is the same Communist Party that hacked the OPM records and now has moved on to Equifax. Can you envision scenarios where the Chinese Communist Party was hacking into the U.S. banking system?
Well, we need to be resilient against all cyber threats, and certainly, state actors are a big part of that. And so we're well aware of those. And by the way, we have help from the intelligence agencies and others in the government in keeping our eyes out for that.
Shifting gears a little bit, the president's budget came out this last weekend, and some of us are going to be in the Finance Committee later today discussing the larger budget. We tend to have headlines that focus on whatever the discretionary programs are that tend to be more hot button and current in the news. But you've talked consistently about health entitlements and its challenge to or maybe more broadly than health entitlements, the inefficiencies of our healthcare delivery system. For a developed nation, we have very mediocre health outcomes, and we have ridiculously high price tags. Can you talk a little bit about the consequences of U.S. health uncompetitiveness on our larger economy?
I'd be happy to. Of course, should start by saying that it's not really, we don't do fiscal policy and we don't give you advice on fiscal policy, but since you ask, really the budget, the biggest issue of our federal budget is just it's healthcare spending, and it's not that our benefits are too generous, it's that we deliver them in a way that is but measured by the outcomes. The outcomes are perfectly average for a first world nation, but we spend 6 or 7% of GDP more than other countries do. And so it's about the delivery, and that's a lot of money every year that you're effectively spending and getting nothing. And I have to leave it with you there. It's not for us or to me to prescribe, fixes, but I think that really is what it's about. It's those discretionary things, of course, are very high profile and they get a lot of reporting, but ultimately that's what's driving it. And again, I would stress, it's not that these benefits are fabulously generous. They're just what people get in Western economies. But we deliver them at the cost of 17, 18% of GDP, and others do it at 11% of GDP. That's what we should be focusing on.
Thank you, Chairman.
Senator Tester.
Well, thank you, Mr. Chairman, Ranking Member Brown, for having this hearing, and I want to thank you, Chairman Powell, for your work. I didn't hear all of Senator Reed's questions, but if it has to do with independence of the Fed, count me on that block too. I think it's critically important you maintain that independence and hang to it, and I applaud you on your efforts thus far. Both the Fed through lower rates and Congress through increased spending, through increased debt, have been taking actions to boost the economy during a long stretch of growth. I am concerned that if we do approach a downturn, and there are a number of indicators out there that are concerning to me, that our options to address a downturn are limited. I want to hear your perspective on what the Fed has as ability to react to an economic downturn, the tools.
Thank you. So our traditional tool, of course, is interest rates, and low rates are not really a choice anymore. They are a fact of reality, and they're likely to remain in. So we will have less room to cut. That means it's much more likely that we'll have to turn to the tools that we used in the financial crisis when we hit the lower bound.
Which is?
Which is forward guidance, which says that we'll keep rates low, and then it's also large-scale asset purchases of longer-term securities to drive longer-term rates down and support the economy. We will use those tools. I believe we will use them aggressively should the need arise to do so. There's no need to do that now, but we will use those tools aggressively. The sense of the review that we're undertaking of our strategy, tools, and communications right now, and which we think we'll announce our conclusions on in mid-year, is that we're looking to make sure that in this low-rate environment, difficult environment for central banks and for those who we work for, that we are using our tools as best we can, that we've explored every possible way to find every scrap of policy space, if you will, to be able to support the economy. And then finally, I would just stress that it's important that fiscal policy be in a position, as it always has been, to support the economy in a downturn as well.
So let me ask you this: the debt's at $23 trillion right now. Isn't that about right? Something like that.
Yes.
At what point in time do you get concerned? I mean, I think the budget the president just put out is another $1 trillion to the debt.
It's very hard to say at what level you get concerned. I would say I'm be concerned now at it's really the rate of increase is what we need to do is have the debt grow slower than the economy is growing. If the economy is growing faster than the debt, then effectively leverage is going down. So debt to GDP won't be. What's happening is debt to GDP is going up and going up fairly quickly as these things move. Other countries have managed to get to very high levels, much more than ours. But what it means is that 20 years from now, we'll be spending those tax dollars, our children will be spending those tax dollars on servicing the debt rather than on the things that they really need. Right. We're sending them those bills.
And the debt doesn't go down if the economy downturns.
No, not at all. Quite the opposite.
Exactly right. It becomes much bigger of an issue.
Yeah.
I want to talk about housing because it's a big issue, I think, everywhere, rural America and urban America. From your position, what do you see the housing challenges impact on individuals and the economy?
It's housing is generally facing difficulties in affordability. I mean, the housing industry is doing better and building more houses and profitable, and housing starts are going up. But I think from the standpoint of the public, you have a squeeze going on to do with difficulty in getting lots. With there are just supply side constraints which are keeping the quantity of housing down. Lack of skilled labor, regulations of various kind, and so what you see many places, not just in big cities, you see housing affordability challenges, and it's a fairly wide scale problem.
And I just want to ask this really quickly because there's been a lot of debate for a number of years. much of it started by my senator to my left on GSE reform. Does GSE reform or lack of GSE reform have any impacts on the housing situation?
I think in the long run, it's very important that that GSE reform happen, that we move forward with that. I think that's a big unfinished piece of business from the financial crisis. It's not really ideal to have the entire housing finance system riding on the federal government in the long run. It would be better to move forward with something, I think. And I think in the long run, that's a more sustainable basis for housing finance.
Thank you for your work. I have some other questions on agriculture. We'll put them in for the record, but thank you very much for your service.
Thank you.
Thanks, sir. Senator Rounds.
Thank you, Mr. Chairman. Mr. Chairman, first of all, welcome. And I just want to echo what some of my colleagues have said about the independence of the Fed. And I think on both sides of the aisle, you'll find strong support for an independent Fed. I'd like to begin by asking you about a rule that I recently filed a comment letter on, and that's the Fed's building blocks approach. As I mentioned in my letter, it doesn't seem to make sense for the Fed to resurrect the original Section 171 calculation from Dodd-Frank. I understand that this particular calculation unintentionally imposed bank-centric capital rules on insurance, savings, and loan holding companies, which have a totally different business model. Congress spoke very clearly through the passage of the Insurance Capital Standards Clarification Act that its intent was for banks to be regulated like banks and for insurance companies to be regulated like insurance companies. Given the clear intent of Congress, why has the Fed chosen to revisit Section 171? How does the Fed intend to move forward?
So thank you for your comment. We got a number of comments on that issue, and we're looking at. Of course, we've looked at the law change, and the question we're asking is whether there's what's the nature of of the change made in the law, and does it apply here? So we'll be reviewing those comments and considering them in getting to a view on that.
As you know, one of the reasons for having these open discussions is to bring attention to it. And the fact that I think it's a very serious issue, and I think it does need the full attention of the Fed, and hopefully you'll get it resolved as quickly as possible to avoid any questions that may be lingering out there.
Yeah, will do.
I'd also like to talk a little bit about, Vice Chair Quarles recently remarked that business fixed investment continues to be weak, having declined over the course of 2019. Do you think it's fair to say that a large part of this is driven by uncertainty with regards to trade, and that businesses are waiting to see how trade tensions are resolved before they're prepared to make further investments?
You know, I would say there are a bunch of factors that we need to look at. One is just the global growth slowdown, particularly in manufacturing. Another is lower oil prices. In the United States, it's a big swing factor in business fixed investment is drilling. Our work and that of many outside economists does suggest that there's also a role for trade policy and uncertainty around trade policy. So, I mean, the short answer to your question would be yes, I do think there's upside there to the extent businesses see the trade situation as having, uncertainty around the trade situation as having declined.
Okay. And I'm just thinking, recently I understand that there's been a discussion about groupthink and about how the Fed approaches it within the meetings. Do you think it's important for the Fed board to reject groupthink and consider a variety of different viewpoints?
I do. In fact, I very much do. I'm strongly inclined to think that you need to hear all sides of a case. In fact, when I was a private equity investor, I used to speak against my own deals just to force people to defend them, so I would really get a sense that I believe in things. So it's critical to have diverse perspectives. I really think we do, though, particularly through the, if you think about it, the Reserve Bank system guarantees from an institutional standpoint that we'll always have diverse perspectives on monetary policy. On regulation, where we get it is from the comments and from the disparate group of people who are on the board. If you look at who's on the board, a number of us have primarily private sector backgrounds, and we bring that to the table.
Pretty fair to say that you can have people from varying points of view that can have very lively discussions and yet, at the end of the day, still be a part of a very strong team.
Absolutely. I really think it just makes you stronger. I do. I mean, I feel that way. And, of course, we've had plenty of dissent at the Fed over the years.
Thank you. One last question. When the board voted on its rule for tailoring resolutions plans last fall, Vice Chair Quarles gave a statement essentially saying that there is more that could be done when it comes to tailoring from a supervisory standpoint. Can you elaborate on how the Fed intends to move forward with this?
So Vice Chair Quarles gave, as I'm sure you know, gave a speech on that and laid out really quite a number of aspects of that. And, you know, so we're going to be, these were ideas. They're not quite at the stage of being proposals yet, but we're going to be looking at those. I mean,
how will they be manifested? Are they going to come out as rulemaking, or are they going to come out as guidance?
Some of it will be rulemaking, some of it will be guidance, some of it will be changes to guidance. If you look at, there's many different ideas. I mean, I think the key thing is he highlights this, the tension between, you know, the right to due process and clarity that we depend upon from our government, right? That should, but also with supervision, there's also a role for discretion and for confidentiality. So I think it's a very thoughtful process of looking at that and asking how can we make it more transparent with more due process, but still effective, because supervision has to be firm but fair.
Thank you. Thank you, Mr. Chairman.
Thank you. Senator Warner.
Thank you, Mr. Chairman. Chairman Powell, great to see you again. Thank you for your good work. I want to make a couple quick comments echoing what Senator Rounds and Senator Reid and others said. I think there's a lot of our institutions, independents, are under assault these days. I share some of the concerns of Senator Brown about the independence of the Justice Department. I fight on a regular basis to try to make sure the intelligence community can maintain their independence. I would ask and frankly plead with you that if you see efforts made to undermine the Fed's independence, that you keep this committee fully abreast. I think the Fed's independence is more important than ever at this point. I want to also follow up on my good friend Senator Sass's comments about Equifax. I share with you the belief of the challenge that China poses. But I also think, particularly in the case of Equifax and the credit rating agencies broadly, none of us choose to be an Equifax customer or any credit rating agency. That break-in, that cyber attack, was due to sloppy behavior by Equifax, and the fact that we have not put in place any, frankly, enhanced rules of liability around these credit reporting agencies is something I know I've talked with the chairman at times, I hope that we would come back to, because I think while we have to be on guard, if we don't have at least de minimis standards and they can bake this kind of obscene break into the cost of business, I don't think that's good for anyone. And again, I hope we'll be able to come back to that. I do have a bunch of questions for you as well, Chairman Powell. Let me just, yesterday in your testimony, you talked about this movement towards digital currency, something I'm very interested in. And you indicated, it was possible that there might be a United States-backed digital currency. We have the possibility of doing that. The question I question is, would that be desirable? How do we, I get the component parts around a digital currency might provide convenience and potentially even lower friction cost in terms of credit to consumers. But how do we weigh in privacy and cyber concerns? How would that deal with our retail banking system? And do you think the Fed has the capacity to do this without congressional approval? Fill out a little bit more, and then I've got one last question about China's role in this space. But talk to me first about the domestic implications.
Sure. So you listed the potential costs and benefits. The benefits would include, perhaps greater financial inclusion, lower costs, more convenience, and all those things. The risks or costs would include cyber risk and fraud risk and privacy risk and things like that. So I think there's a lot to weigh and a lot to work on there. Every major central bank in the world right now is doing a deep dive on digital currencies, and we think it's our responsibility to be at the very forefront of knowledge and thinking about a central bank digital currency.
Would you take a a positive action on that without congressional input? Do you feel like you have that authority?
So it would depend a lot on the design choices. It's a good question. One that we're working on. I'd say we're working very broadly, including working with other central banks around the world on this. And there's just a lot of thinking and experimentation and understanding that we're gaining. And if there's a need for, if we conclude that we need more authority and that this is something appropriate to do, then we'll ask for the authority.
Well, one of the things you mentioned yesterday, and I can share Senator Sass and a number of us who are on the Intel community concern about the rise of China in a series of areas, and I think it is clear that China may move quicker than us on a digital currency. You said you've got some visibility into what China might be doing on digital currency. I'd love you to spell that a little bit. Do you think they'll use their influence through their kind of Belt and Road investment strategy and the number of countries that have kind of bought into that system, that they might be then also buying into that Chinese digital currency? What would that do in terms of cross-border? What would that do in terms of dollar supremacy? Any further guidance you might have on your insight into China's actions in this space would be helpful.
I would just say we have to assume that what would that mean? We have to ask the question, what would it mean if China had a digital currency that had fairly wide adoption, including to other countries? We've got to ask that. I think we've also got to ask, what if a private sector entity, a large company with a large network of users, has a digital currency? So we're looking.
That's already popped out, and I think we had pretty bipartisan concerns on that one.
So that's why we're doing all this work. We understand I would say Libra was something of lit a bit of a fire. This is something we've been focused on digital currencies for a couple decades, but it's really lit a fire around the world right now. So we are doing a great deal of work.
My time's up. I just want to say I would urge, having seen China's ability to move aggressively in a series of other areas, that you start forging that coalition of the willing amongst other central banks sooner rather than later. Thank you, Mr. Chairman.
Senator Perdue.
Thank you, Chair. Mr. Chairman, thank you for being here again. It's good to see you. I just have one quick question in light of the time. We have two dynamics right now that are driving the economy in different directions potentially. Labor is now a limiting factor in terms of we've got roughly 7 million job openings and about 5 million people looking for work. So it's a phenomenon right now that's a limiting factor. On the other hand, we have low energy costs. Since 2007, where we've doubled our output of oil, such that now we are a net exporter of oil and gas, the largest producer in the world. 8% of our economy is energy. 15% of our CapEx is going to that. Today, we produce 50% more barrels of oil a day than Saudi Arabia, and about 18% of the world's output. My question is, are we in a low energy price environment, and what assumptions are you making that over the next decade, and what impact do you think that will have on inflation, deflation? I know you've talked about deflationary concerns in the past. Where are we today on that big factor in our economy, energy?
So it's been transformational. If you think back when we were in college, if energy spiked, inflation went up, people got out of work, there were long lines at the gas pump. We now have a very large domestic energy industry, which amounts to a shock absorber. When that happens, U.S. drilling goes up with the price of oil, puts people back to work, it controls prices, it controls inflation. So we're in a situation where that particular mechanic for inflation going up, it's just not happening anymore because the supply response from the U.S. industry is quick and large. So you won't see that having sustained effects on inflation, and also you won't see it having sustained negative effects on growth because it kind of roughly offsets the effect of lower energy prices at the pump. That will slow the economy down a bit, but the new supply that comes on will put people to work. It'll be different people, but overall, it's a very different and better place to be.
Are you concerned about the workforce participation rate with the growth of jobs over the last 3 years? Workforce participation recently has bumped up a little bit, but it really hasn't moved as much as one might have thought.
It is greatly surprised to the upside, which is a great thing. But remember that the prediction, basically what labor force, just because of demographics, participation should drop by about 0.25% a year. It's now been flat since 2013. We think there's more upside. So that what's happening is labor is tight everywhere, but actually there's a supply response from the public, which is a very positive thing. And, you know, we never thought we'd see 63.4% labor force participation again. Nobody had that in their model 7 years ago, but that's what we have, and it's really a very positive thing.
Good. Thank you, Mr. Chairman. Light of time, Mr. Chair. Thank you very much. I'll yield back.
Thank you. Senator Schatz.
Thank you, Mr. Chairman. Thank you, Chairman Powell, for being here. First question, how does income inequality impact economic growth? There's a lot of talk on the policymaking side of the impact on families. How does it hit your analysis, and what can be done on your side of the shop?
Well, obviously people who are at the bottom end of the income spectrum, whose incomes aren't growing, their consumption will be constrained. You know, their consumption will be constrained, and their marginal propensity to consume out of new dollars will be high. To the extent gains are going to the people at the top, their marginal propensity to consume out of wealth will be low, so that it won't be hitting GDP. It'll be going into savings. So those are effects that will show up, you know, quite gradually over time. Inequality is a gradually moving phenomenon.
Talk to me about the relationship between productivity and unemployment. Is there a new relationship that's emerging? Is there any new thinking along those lines? Because I think the traditional analysis is productivity goes up. That's basically good for the economy. But it seems to me that at least the way people perceive it is that those two things are decoupled, that productivity goes up, that doesn't mean wages go up. And I'm wondering whether that's a change or if that's a sort of more of a political overlay to say, hey, look, things may look good, but we're still on the bottom eating your scraps. I'm wondering whether it's more than that and that there's actually a change in the way you analyze this.
Well, I think we're always learning. And we're always learning, and we've seen relatively low productivity in the wake of the financial crisis, and it appears to be persistent, and that's going to mean lower wages. Ultimately, you need rising productivity to create rising standards of living. It just has to be that way. It doesn't mean in any given year you will see that, but you do see a pretty tight connection between if you add in benefits, not just wages, but look at the full cost of employment. You see I won't call it tight, but you see a connection between rising productivity.
I guess the question is, they're no less correlated than they used to be?
I wouldn't say that. No, I would say if you look at the moment, if you think of wages as being right around 3%, productivity growth has been low. It's just recently moved up. It recently moved up close to 2%. And inflation is 2%.
Yeah, the other thing I'd add is that if you're doing total compensation, if most of the increase in total comp is just that the employer absorbed a 7% increase in healthcare costs, you know, that's not really an increase in wages in the traditional sense. I get that from the employer standpoint, it sure feels like an increase in wages, but if you're trying to maximize compensation, it means nothing to a regular person who says, okay, I guess I got no more money, but it costs my employer more, so I should be happy about that. Let me just move on to climate. I have a couple of questions. What's the Fed doing in regard to climate-related financial disclosures? I know you're making some progress. I'd like you to talk about that.
So, I mean, I think like others, other central banks, we are at the beginning of the process of understanding how climate change affects our work. I think one way we know that it will affect our work is that the public will count on us to make sure that financial institutions that we regulate, central counterparties, banks, things like that, will be robust to the risks that come from climate change. And we're at as I said, the beginning of understanding exactly what all that means. In terms of disclosure, you know, it's more really an FDIC issue. You know, they're the ones who regulate appropriate disclosure. I think they've been doing some work on this lately.
You had an exchange with a member of the House, I think it was yesterday, and the question was whether we ought to be stress testing for climate risks. And you said you're watching the Bank of England. I'm wondering if you can elaborate on that.
So they are doing stress tests which are not at all connected to the CCAR, what would be the CCAR process, which is the one that relates to the amount of dividends and that distributions that a company can have. This is more just exploratory. They're exploratory scenarios, and we're very closely monitoring that. We have good relationships with all the major central banks, especially the Bank of England and others. So we'll be looking at that, and it's something we'll be thinking about. We haven't made any decisions, but as I said, these are early days. We're actually doing a fair amount of work all through the Federal Reserve System on understanding this emerging risk.
Thank you.
Mr. Chairman, thanks for being here. I think you're doing a great job.
Senator Kennedy.
Thank you.
Thank you, Mr. Chairman. Our labor force participation rate is much better.
Sorry, I blew it.
But compared to other OECD countries, we lag. Why?
That's a great question. So it is a combination of things, no doubt. It is that educational attainment in the United States, which was once the highest, has really fallen relative to our peers, and particularly among lower and middle income people, the level of educational attainment has really plateaued.
Right.
And that's the key thing for keeping in the labor market.
What
these
else?
days. That's one. I would say the opioid crisis isn't helping. I would say, if you think about it, both globalization and technology probably advantage people of relatively high education and don't advantage people, for example, in manufacturing. So if you think about what's happened to the manufacturing base in many, many countries, a lot of those jobs have either been automated or moved abroad. The manufacturing that we have now is very efficient and doesn't use as many people.
What else? Has trade played an impact?
Sorry?
Trade
Yes.
tariffs?
Well, I would say trade tariffs. Through this period, we really have had declining tariffs since World War II until lately here, and we've had increasing labor force participation here because of this underlying strength.
Does the richness of our social programs play a part?
It's very hard to make that connection, and I'll tell you why. If you look in real terms, adjusted for inflation, at the benefits that people get, they've actually declined during this period of declining labor force participation. They have not gone up in real terms. So it isn't better or more comfortable to be poor and on public benefits now. It's actually worse than it was.
Right. It seems to me that and there's going to be a question in here, I promise. It seems, I know sometimes you never get one, but
that's okay.
It seems to me that any fair-minded person would have to conclude that our economy is better. I'm biased, of course, but I think the Tax Cuts and Jobs Act worked. And we have seen wage increases, including but not limited to the bottom quartile. And we have seen unemployment go down. But we still have a problem in America and a lot of anger. And I think the root, this is one person's opinion, but the root of a lot of that anger is that we still have too many people in this country who aren't participating in the great wealth of this country. Not economically, not socially, not culturally. I think Sanders supporters and Trump supporters have more in common than they realize. The American dream has become the American game to them, and they think it's fixed. Now, the managerial elite's doing fine, but I'm talking about ordinary people. What, if any, role do you think the Fed should play in helping us address that?
First of all, I think there's a lot in what you said. The single most important thing we can do is take seriously your order to us to achieve maximum employment. Maximum employment, that's what the law says. And that's what we're doing. We're using our tools to keep an eye on maximum employment, and I think there's no reason why the current situation of low unemployment, rising wages, high job creation, there's no reason why it can't go on. There really isn't. There's nothing about this economy that is out of kilter or imbalanced. That's the main thing that we can do. We do other things that are in the nature of convening. You know, we do a lot of research in your state and others. The Federal Reserve Bank will have an operation where they're trying to convene resources around issues of education and poverty and things like that in poor communities. But we don't have the ability to spend money on it. We get community people around a table and try to organize things that help the community, as I'm sure you know. So it's not really something we can do a lot about other than research and do our jobs on monetary policy.
Thank you, Senator Kennedy. Senator
I
Cortez
think if I could have another 10 seconds, Mr. Chairman, I was distracted because you were talking. Stay independent. I think you're doing a great job, and all of us in politics are going to give you plenty of advice, but call them like you see them. Thank you.
Senator Cortez Masto.
Thank you, Chairman Powell. It's great to see you again. Thank you so much for being here and always being responsive. Let me follow up on this line of discussion of maximum employment, and I so appreciate the conversation. You keep talking about a level of educational attainment that is so important. What do you define as that education? When you talk about that, what does that mean?
Anything that gives you skills that would work in the workplace. That could include internships. That could include the kind of training that people are getting now who go right out of high school into a program. It's not meant to be limited to college as such, or getting a liberal arts degree. It's really the acquisition of skills in society.
So, do you think we have changed in society that it's very difficult now to just graduate from high school and get a job that pays a decent wage for your family without getting some sort of additional education?
Yes, it is. I mean, I think you see that very much. For people with high school degrees, their incomes have stagnated, badly for a long time. It's the economy. What happens with technological change is that it wants higher and higher levels of skill, and if society provides those people and those skills, then incomes can go up across the board and inequality can go down. And that was the American story for a long, long time.
Sure, but it isn't part of that, and this is why I'm curious your thoughts on this. Part of that also has to do with the wages and the increase in wages and the level of wage that you're paying. Are you saying just because you graduate from high school, you shouldn't, and you want that job, whatever that job is that you're able to do, it should be a minimum level of wage that should never increase, even with the gains in productivity that we've seen over the years?
No, I'm not saying that at all.
Okay, good, because I agree with you. Because I think there are also people in this country, and I so am pleased with the high unemployment rate, but I also think, and they live in my state, that are working 2 jobs. They're actually working 2 jobs because the wages are so low. And I think there is a disparity that we have to do a better job of understanding. I was looking through the monetary report that you gave, and I'm curious, do you identify, because I didn't see it here, but do you identify those individuals who are actually working 2 jobs?
Those are identified in the data collected by the Bureau of Labor Statistics, yes.
And that's what you utilize here, and is that data that you can provide that gives us a better understanding of how many Americans across this country are actually working 2 jobs just to make ends meet?
Very high level right now.
Yeah, and that's what I would like to see. I think that would be helpful for us as we work with you moving forward. Let me just, one final question, because I know the votes have been called. You note in your opening remarks that there are troubling labor market disparities across racial and ethnic groups and across regions of the country. Can you go into more specifics with that statement?
Sure. So I think we had a box in our monetary policy report, I think a year ago, about the rural and urban disparities, which are just getting wider and wider and wider. And it talked about, what might be causing that. And, you really have a long-term trend here that's challenging for people in rural areas. In terms of racial and ethnic disparities, I mean, the African-American unemployment rate is roughly twice that of the overall unemployment rate. And, that you see different groups. And so it's troubling that these things would persist in this way. We don't have the ability to operate directly on that, other than, again, by carrying out our mandate of maximum employment and stable prices.
But as you study it, what are you finding? Why is there that disparity? What can you point to?
Which disparity?
That would be helpful, the racial disparity that you just talked about.
I think it's tied into history, to our history, and there are higher levels of poverty in the African American community, as you know, and that's because of our history, but we'd like to see those gaps declining more than they are.
Okay,
and
thank
not tools that we have, tools that you have to do.
But there's nothing, and what I'm looking for is the data. There's no data set or data points that you're collecting that helps us identify that racial disparity, why it's occurring, and how we can address it.
Oh, there's lots and lots of research on that. We'd be happy to.
That you have access to.
Sure.
Perfect. That's what I'm looking for. Thank you.
Senator Tillis.
Thank you. Chair Powell, welcome back. Thank you for a lot of the good work you're doing over in your lane. I do have a couple of questions. The first one that I want to talk about, we've seen, particularly in the FDIC, we've seen a real stepped-up effort to take a look at guidance and other actions short of an APA promulgated rule to rethink and revise or rescind. Can you give me an idea of how that's going on in the Fed?
Sure. So, we've forthrightly said that guidance is not a rule. Guidance is not binding. It's not the basis for enforcement actions and things like that. And we've made that very clear to our supervisors. So I think you may have seen Vice Chair Quarles' speech where he addressed some of these issues. So we're working on that as well.
One, if we drill down, I know you're aware of the GAO ruling on LISIC. There's a lot of talk here. I happen to agree with the discussion that you all need to remain independent, but there's something that concerns me that came out after you received the word from the GAO or OMB, and it relates back to, I think, a letter your general counsel wrote back in June of last year, which I have it in front of me now. It says that you're continuing to assess the scope of the Federal Reserve's obligation to send supervisory guidance documents to Congress under the CRA. Does that mean you're exempt from that oversight?
So the question of whether we're required to send guidance. We do send some guidance up. And again, this is another one that Vice Chair Quarles addressed.
So what's the current position on the LISIC consultation from the GAO?
So
are you taking LISIC down?
On LISIC, what we're going to do with LISIC is we're going to, I think, articulate clear standards for what firms should be in LISIC. In fact, Vice Chair Quarles already laid out an approach which I think makes a lot of sense, which is LISIC should be for the U.S. GSIBs, and really try to tie the whole approach more to the tailoring categories that we set up.
Now to the other CRA, that's the Community Reinvestment Act. One question, rumors swirl around this building probably the way they do in the Fed and the whole of government. So the question that I have is that relates to the Fed's plans for either joining with the FDIC and the OCC on the rulemaking. Some have said that you've provided an assurance to Waters that without Governor Brainard's support that you would not join into that. Is that just a rumor or an assurance that you've given Chair Waters?
That's not how we're looking at it. What we're doing is we're trying to we developed our own thinking on CRA reform, as did the OCC. They took a lot of our ideas, but in the end, we were not able to get on the same page. And I'm very comfortable with where we are now.
What would be the rational basis for two standards?
There are going to be two standards anyway. Under the FDIC-OCC proposal, about 70% of their institutions will be able to opt out of that standard. So there's going to be the existing standard, and then there'll be the new standard, assuming that they go forward with it. So there'll be two systems, and we'll just be, if we don't do anything, then we'll just be like the 70% of the institutions that they supervise.
Is Vice Chair Quarles on point for this?
Is he on point for this? He's
wouldn't the Community Reinvestment Act be within his lane?
It's certainly broadly within all of our lanes on the board. We'll all have to vote on this. This actually has always been handled by a different group, which is DCCA, which Governor Brainard chaired, and I asked her to take the lead on this. But ultimately, it comes down. I am very comfortable with where we are on this.
Thank you. I've was going to ask some questions similar to Senator Toomey's. I won't on the on FedNow, but I'm only going to submit some questions for the record that are just basically about the mechanics of the FedNow implementation. 5 straightforward questions. Thank you.
Thank you, Mr. Tillis. Senator Jones.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. Let me echo other colleagues on both sides of the aisle regarding the independence of the Fed. I concur that it is extremely important that we maintain that independence. I want to ask you a little bit about home ownership. It kind of follows up a little bit with what Senator Kennedy was talking about, wealth gaps between so many Americans. It seems that nationwide home ownership is relatively stable, but there is also massive disparities in home ownership by age, race, ethnicity. African-American home ownership rate fell to a 50-year low in 2016 at just 41.7%, remains about 30 points below white home ownership. Similarly, Hispanic ownership rate is just 48%, again, far below the white or average home ownership rate. Millennials are less likely to own a home by age 34 than their parents or grandparents, and I'm concerned that if trends continue, and by that I mean to some extent we've got relatively the wages are rising, but they've not been rising as fast as we would like. Home ownership costs are increasing at a greater rate. So I'm concerned that if these trends continue, a growing number of Americans are just going to get locked out of home ownership. So my question, what are the economic consequences in terms of both wealth building for minorities and the broader economy of leaving the disparity in the realm of home ownership unaddressed? And do you have suggestions of how we in Congress or the Fed can address home ownership?
Let me say first, I would agree with you that there are pressures on affordability which are very widespread that to do with difficulty in getting land zoned and difficulty in acquiring workers and just costs, regulatory costs, material costs are really putting pressure on house prices, upward pressure. And it's, as I said, quite widespread around the country. You know, in terms of the level of home ownership, I think we don't want to be back in a situation where we push the idea of home ownership past what is financially sustainable for people, and we kind of did that in the pre-crisis era. So what's happened is that credit is much less available now for people without spotless credit records, and that's a lot of what's behind some of the data you cited. And I think it's a good question. Do we move too far? I don't have a view that we did, but I think it's a good question to be asking on that, and just making sure that people who should have access to credit and can handle borrowing of that size get it.
It seems that, and I know Senator Cortez Masto was asked, I'd like to get some of that same information, by the way, about the racial disparities, because I assume there is some connection with that in economics as well. Let me, in the short time I've got left, go back to the lower rate of labor force participation. How can we just encourage that? How can we get more participation and get those numbers up? What can we do? What can you do, if anything, to try to get more folks in that participation in the market?
So what we can do is continue to use our tool to support a strong labor market. And it's very good to see those participation rates rising to the levels that people didn't, I mean, economists didn't think we'd see those levels again, and we're seeing them, which is a really positive thing. But that's, you know, longer term, that's not really a strategy. We need policies that will, ultimately people have to have skills and aptitudes that will keep them in the labor force, and ways that they can take part in the labor force. And I think that's where other government policies come into effect. And, you know, it's a lot of education and training, and also policies that will support attachment to the labor force. And, you know, there's a lot we'd be happy to sit down with you and talk about that. But that's important. Other countries that have leapfrogged us do more of those kinds of things, and also have had more rising educational attainment, which I think all of those things will help.
Great. Well, thank you for that, and I look forward to discussion about that a little bit. Thank you, Mr. Chairman. I'll yield back.
Thank you. Senator McSally.
Thank you, Mr. Chairman. Chairman Paul, on February 2nd, the American Banker published an article, was titled, "When a Small Town Loses Its Only Bank." The article mentions Duncan, Arizona, which had only one bank and recently closed its doors. The residents of Duncan are now forced to drive approximately 40 miles to conduct any banking. Local businesses are no longer have a place to deposit, make daily deposits, or get change, and any customer service issues require driving long distances. The article states that, quote, the economic implications are enough of a concern that the Federal Reserve has been studying what happens in areas where residents no longer have access to a local branch. So my first question is, what has the Fed learned in that study, and why do you think this is happening? It's not just happening in Duncan, Arizona, but really across rural Arizona and rural America.
So we did, and we published the study, as you mentioned. We had meetings all around the country and did research, and I think we did find that the loss of a branch, particularly in these rural communities, can be a serious blow. It's the availability of financial services, but it's also a bank is an important civic citizen and contributes in many ways to that town. And actually, I think we had an event in Duncan. I think that was one of our events. Now that I think of it, so we learned that, and you see it happening. Bank branches are going down have been reduced in a number of jurisdictions, but you see it more in rural, and also the people who are in rural areas are more inclined to use a bank branch rather than electronic banking.
Exactly.
So the effects are really significant. So we saw that, and it's quite a negative effect.
So how do you, these are banking deserts. How does the Fed define a banking desert? Is it just about geographic distance needing to travel, or the number of customers, or any other economic statistics for this? And you're absolutely right. While more people in urban areas may be using online banking, rural areas have two challenges. One is they're possibly less inclined to do that. That's not part of the culture. But also we have connectivity challenges without rural broadband. So those two things further hurt rural communities. So how do you guys define banking deserts, and what else can be done to address this issue?
So there actually isn't there's no accepted definition, but I think it's one of those things where you know it when you see it. So it's a place where people don't have access to basic banking services. Duncan would be a classic example. The fact that you'd have to drive 40 miles to get there, that's a banking desert. It turns out that many of these banking deserts are actually in the high desert, by the way. So that's another indicator.
Go figure.
But yeah, no, it's a real issue in rural America, principally.
Do you have any ideas, within your role and our role, on how we can address this issue?
Yeah, so we can't be in the business of ultimately of telling banks that they can't close branches,
right?
But we can find incentives for them to support rural areas, and CRA reform may be one vehicle for that, where we can move CRA. And this is a constructive aspect of the other agency's proposal is moving to support more activity of a CRA nature in rural areas. So that's one idea. It's challenging, though. As you know, for quite a while now, people have been leaving rural areas and moving to the cities. So these are longer-term demographic pressures.
Great. Thank you. I appreciate it. Look forward to maybe following up with you, talk more about this.
Glad to do it.
This issue. Thanks. I also want to touch on the labor force participation and wage growth issue. I know many members have already asked you about it. But it's really great to see so many Americans and Arizonans coming off the sidelines and getting back into the workforce. And we're starting to see, wages go up as well, especially for the lower levels of the economic spectrum. Can you just touch on a little bit more the dynamics that you're seeing, the positive nature of that, and where you're seeing people coming off the sidelines and how wage increases are impacting?
Sure. So it's a combination of people just not leaving as much and people actually coming back in. As you may have seen, unusually at this point, most of the people who are newly employed do not come out of unemployment. They come from out of the labor force. So we break down everybody into different categories. That the biggest flow, I think by far now, is from out of the labor force to employment, which is clearly a sign of relatively low unemployment. There's just fewer people that are unemployed, but also just that there are people who are outside the labor force who are having job opportunities. So that's very positive. The thing is, we didn't expect this. It's very positive, and we just want to do whatever we can to continue to foster this trend, because there's nothing like a job to get people's lives right and get them on a good track. So it's very good to see this, and we're using our tools to make sure that we can foster that.
Great, thank you. I'm out of time. Thank you, Mr. Chairman.
Senator Van Hollen.
Thank you, Mr. Chairman, and thank you, Mr. Chairman. And like my colleagues, I want to thank you for your accessibility and always appreciate the opportunity to have a fact-based conversation here. Before I get to some of my questions, I just want to thank you and the Fed for moving ahead on the Fed Now system. I think it will save millions of Americans billions of dollars when it's implemented. Now, we passed a huge tax cut back in December 2017. It dramatically increased the annual deficits and the long-term debt. And at that time, in December 2017, here's what President Trump tweeted out. He said that his tax cuts were going to rock the economy to growth rates of 4%, 5%, and maybe even 6%. Mr. Chairman, the economy hasn't gotten anywhere near 6% growth in the last 3 years, has it?
No, we've had continued moderate growth of a little better than 2%.
Right. And we haven't had growth at 5% or 4%. And in fact, the Trump administration has not ever hit 3% annual growth, has it?
So 2018 was marked at 3%, but then got marked down, actually, to 2.5%. Right. You never know. Maybe it'll get marked.
But we're having a reality-based conversation. So the answer is no, right? It has not hit 3%. Is that right?
According to the current statistics.
Yeah. And if you look at the budget that was just submitted by the Trump administration, they're predicting 2.8% growth for the coming year. Again, very far from what President Trump was talking about, 4, 5, 6%. But even at that number, 2.8%, that's higher than the most optimistic projections for the 2020 GDP from the 17 FOMC members, right?
So we don't have a unified forecast. We don't adopt or vote on a forecast, but we do show a dot plot or show disclosed data. And I think the median forecast would be in the low 2s for FOMC participants for this year.
Yeah, if I look at the median forecast, it's actually 2%, and the most optimistic bullish was 2.3%, still a full 0.5% of GDP below the president's projections. So let me now turn not from the aggregate numbers, but to the real wages, because there's been a lot of hype lately, but I want to get a sense of where people really are. And obviously, it's good news that the unemployment numbers have continued to come down on the trajectory they were following when President Trump was sworn in. But if you actually look at real compensation, and I recall from an earlier hearing, your view is that the Employment Cost Index, ECI, is probably the best measure of compensation. Is that right?
It is, in a sense, it is. They all have their little virtues, though.
Right.
That's
so I'm just was looking at the numbers, and compensation grew by an average of 0.94% per year during President Obama's second term, and that compares to 0.63% per year. This is in inflation-adjusted terms, 0.63% growth in compensation under President Trump. So in fact, the real compensation that workers are getting in the workforce was actually higher during the Obama's last term compared to now. Is this a reflection of how difficult it's been to actually translate overall economic growth into higher real wages for Americans?
Yes, it is. I mean, part of that really is that inflation has moved back up a little bit, which is something we've been actually trying to accomplish. But I think more broadly, though, wages have moved up from about 2% to about 3% now. And you would, if you look at other expansions, even adjusting for productivity, you would have expected them to move higher than that. So it's a bit of a surprise that we haven't seen real unit labor costs move up, which is to say that people are getting paid more than productivity and inflation in what should be a tight labor market, but isn't showing up as tight in wages.
Exactly. And you say inflation, went up, and that was the intention. But of course, when it comes to real purchasing power for Americans, that's what they care about, whether their wages are able to make purchases. We don't have time to get into it, but the budget did just come up here. The chairman of the Senate Budget Committee has announced he does not want to have a hearing on the budget. I hope he'll change his mind. But a lot of the cuts that were made there include cuts to student loan opportunities and some of the things that you mentioned that actually could lead to higher productivity in the economy. So I'll follow up with some written questions on that. Thank you.
Thank you. Thank you, Senator Cotton.
Thank you, Mr. Chairman, for joining us again. I want to speak today about coronavirus and its potential impact on the U.S. and the global economy. Yesterday, Senator Menendez and I and a couple other senators introduced a resolution honoring Dr. Li Wenliang, a Chinese doctor who died last week of coronavirus. What makes him unusually notable among the now more than 1,000 victims of the coronavirus is he was one of the first persons to blow the whistle on the Wuhan coronavirus in early December. He was silenced by the Chinese Communist Party. In fact, he was summoned in the dark of night and forced to sign a statement denouncing his warnings. Then, unfortunately, he contracted it and died, leaving behind, as I understand, a wife, a small child, and another child on the way. Another example of these kind of practices I want to cite is the Chinese lawyer and journalist Chen Qishi, who was known for reporting on the conditions in Wuhan. He has since disappeared. I raise these examples, and I could multiply them at great length about, or as just a simple illustration of Chinese dishonesty and lack of transparency in trying to handle the effects of this outbreak. Obviously, that has most important impact on our ability to understand the virus and develop effective test and vaccine for us. But what kind of effects does it have on you and the Fed's ability to try to understand the economic impact of it, dealing with such untransparent conditions coming out of Beijing as you get a grasp of what the possible impact could be for China, for the United States, and for the global economy?
So as you point out, the real question for the Fed is what is the likely effect on the U.S. economy? And I think we'll see that. We'll begin to see it in economic data coming up fairly soon, and it's too uncertain to even speculate about what the level of that will be and whether it will be persistent or whether it will lead to a material change in the outlook. But we do expect that there'll be some effects. The effects should be substantial in China, important but maybe less substantial in their immediate trading partners. And we'll be looking at the economic data, and I can't really comment on the other kinds of data. We look at that too.
Sure, and no, of course I wouldn't expect that from the Federal Reserve. Get that from HHS and CDC and other agencies like that. Are Chinese economic or central bank officials in contact with the Federal Reserve or their other counterparts around the world to try to help you and your counterparts understand that economic impact, though, recognizing the dishonesty and lack of transparency that health officials and political leaders?
I'm absolutely sure that will be the case. There have been some conversations, but I think it's too early to say. I think no one really knows. I think their focus now, the big focus there is containing the outbreak. And of course, the central bank and the government itself the rest of the government have been undertaking lots of measures to support economic activity. I think certainly as they know more, we'll know that too. We of course have that kind of a relationship with their central bank.
Okay. I want to commend the Trump administration for taking decisive action a couple of weeks ago to stop travel from China and the other steps they've done in terms of contact tracing and trying to get testing kits out to the front lines. So right now, as of this morning, I think we only have 13 confirmed cases in the United States. I think we're going to be confident there's more than that, but hopefully there won't be many more. If that remains the case, if there's not a widespread outbreak in the United States because of the actions the United States government took, is the main economic risk to the United States the fragility of supply chains that originate in China and what happens at the very beginning of those chains in factories which may not have any or sufficient workers?
You're right. Supply chains is an important issue. We import a lot of sort of intermediate goods from China and final goods too. And that will be an issue. It'll also be our own exports there, of course, will be suppressed during this period. We won't get as much Chinese tourism. And then the other channel I would mention is just financial markets, which can create their own transmission into the economy to the extent there are really strong reactions in financial markets. So we'll be looking at all of that, and again, we do expect to start to pick it up relatively soon.
Okay, thank you, Mr. Chairman. Of course, far and away the top priority of our government must be the health and safety of our people, but we don't want to lose sight of the potential economic harm to our people's well-being and prosperity. So I appreciate your attention to this important matter.
Senator Menendez.
Thank you, Mr. Chairman, for your service. Let me ask you something. The Northeast Corridor, where I come from, in New Jersey, New York, that region, generates about 20% of GDP for the entire nation. If we had a major infrastructure failure, for example, the closing of one or both of the Trans-Hudson tunnels into New York City, the end of the Portal Bridge, which is the linchpin that takes Boston to Washington throughout the Northeast Corridor, would that not create a significant economic risk?
If it were sustained, yes. I mean, if you're talking about a sustained closing, that could. I mean, things happen and then we fix them and they don't show up much in GDP. But if they're sustained, then yes.
Well, let me just share with you something I'd like to bring to your attention as you look at these issues. Amtrak estimates that a shutdown of the Northeast Corridor for a single day, talk about sustained issues, would cost our economy $100 million. Again, that's just in one day. So if we cannot get this infrastructure to ultimately be sustained, and we saw through Superstorm Sandy tremendous damage to the Trans-Hudson tunnels. They're both a century old. We have a century-plus bridge that doesn't close correctly, that stops the entire traffic across the Northeast Corridor. So every lawyer, every medical patient, every business that does intercity rail travel across from Boston to Washington gets stopped and loses time, and if it can't be closed successfully, they take sledgehammers to close it. That has a significant economic impact. And I would urge the Fed to look at that as a question about our infrastructure needs. That's why I'm so frustrated by the administration not seeing the importance of what we call the Gateway Project, 2 new Trans-Hudson tunnels, the rebuilding of a 109-year-old Portal Bridge. We just got some good news on that. But overall, this is a project of national significance in a region of the country that generates 20% of GDP, for which intercity rail traffic is incredibly important. Let me turn to the Community Reinvestment Act, which I think is an essential tool as one of the minority members on this committee and in the Senate against discrimination, about curbing redlining, meeting the needs of low and moderate income families. However, instead of strengthening this important civil rights law, the OCC and the FDIC released a proposed rule that relies heavily on a dollar ratio metric for measuring all of a bank's CRA activities and gives little value to community input. Mr. Chairman, why is it important for an updated CRA rule to focus on loan count rather than on dollar value of a loan?
In our thinking, loan counts are important because they go to the very purpose of the statute, which is to assure the provision of credit to low and moderate income individuals and to their communities. So we think that loan counts are an important aspect of that, in fact.
Do you agree with Governor Brainerd that focusing on loan value, as the updated OCC and FDIC proposal does, quotes, runs the risk of encouraging some institutions to meet expectations primarily through a few large community development loans or investments rather than meeting local needs?
I think it's a risk, and really, as you know, we worked to try to get fully aligned with that proposal. We weren't able to get there. They weren't able to get to our proposal either. So we're going to be looking to see the comments on all those provisions, which will be coming in. We'll be carefully looking at those as we think about our path forward.
When you say that, did you share, the Reserve, share its concerns about emphasizing metrics that place too much value on loan volumes and not on the community input?
Yes, we shared all of our work, and we tried, and they took many of our ideas, by the way. They incorporated a lot of our ideas, so.
They did?
I think, yes, they did, but
Could
we
your
were not
office
able to.
send us what particular items were incorporated that you shared with them?
Sure, well, they've Comptroller Otting has identified many of them in his testimony in the House a couple weeks ago as ideas that they had incorporated from our work.
But the key concern seems to have been ignored in particular. The one that
So I think their proposal looks at both counts and dollars. So but there are a number of differences,
So, a final question on this. Have either you or Governor Brainerd taken the CRA proposal to the Federal Reserve Board yet?
No, we haven't. Our focus was on trying to get on side around one proposal with the OCC and the FDIC, and now we see ourselves as waiting to learn more from that process.
Well, for those of us in communities of color, this is critically important, and I hope the Fed will show leadership in this regard and make sure that the community participation continues to be a hallmark of what the CRA is all about.
Thank you, and that concludes the questions, although I am going to come back and ask one quick question. It wasn't on my list to start with. You've been asked a lot, Mr. Chairman, today about wages. I just want to verify a statistic with you that I'm familiar with. My understanding is that wage growth was 3.1% last year.
That's right. That's average hourly earnings for the 12 months ended December 31.
And did that make 18 straight months that the wage rate was above 3%, the wage growth rate?
I'd have to check that. It takes you back. You're not looking at each month. You're looking at it over the levels 3.1% higher. We could fact check that. That sounds right, though. That sounds right.
Yeah, I think so. Well, if you would fact check that
Will
for
do.
me and let me know, I'd appreciate it. That does now conclude the questioning, and for the senators who wish to submit questions for the record, those questions are due to the committee by Wednesday, February 19th. Chairman Powell, we ask that you respond to those questions as promptly as you can. And again, we thank you for being here. I'm late for a vote, and I'm sure you have other business to conduct, so this committee is adjourned.
Thank you, Mr. Chairman.